Our analysis of the material last time centered on Grab-A-Gun Digital Holdings, Inc. Today, we are shifting our focus to Outdoor Holding Company, formerly known, of course, as Ammo, Inc. It operates primarily in two segments: ammunition manufacturing, though that's seen major asset sales recently, and the gunbroker.com marketplace.
And this company presents, well, a fascinating and I think deeply challenging financial puzzle, precisely because of those recent structural changes. You know, we aren't looking at a stable entity here. We are analyzing a company really mid-metamorphosis, which introduces immense complexity.
Absolutely. And the critical question we have to address, based on the current financial snapshot, is really this. Does Outdoor Holding Company, characterized by, substantial balance sheet liquidity, but also plagued by extreme operational losses and this massive strategic transition, does it truly represent a deep value opportunity, maybe ripe for a successful turnaround, or does the scale of the operational distress signal critical ongoing financial instability?
Well, I'm going to contend that the overwhelming severity of the negative operational margins and that, frankly, drastic revenue collapse fatally undermine any perceived strength from the balance sheet. Until we see clear evidence of sustained profitable operations in the remaining segment, the data points towards continued high risk and potentially more value destruction.
And I'll argue for the opportunity. I think the company's valuation metrics, specifically its low price relative to assets, combined with its frankly exceptionally robust balance sheet strength, provide a pretty substantial safety net. The current price reflects operational issues that are, importantly, being actively addressed and hopefully resolved through the recent strategic asset sale. The market, I think, has priced in the historic pain, but the foundation for the pivot looks stable to me.
Okay, well, let's start with that operational pain then, because the numbers are stark. My perspective really begins and maybe even ends with the income statement distress. Outdoor Holding Company, prior to this transition, has basically been a machine for destroying shareholder capital. Just look at the profitability metrics. The operating margin stands at a crippling negative 41.32%, and the profit margin is a deep negative 46.72%.
Right, but those are trailing 12 months figures, which, capture the performance before the major corrective action was fully realized, wouldn't you say?
Sure, but the effect is tangible and immediate. This leads to horrific capital inefficiency. The return on invested capital, the ROIC, is sitting at negative 25.15%. Now, when ROIC is this negative, it means for every single dollar invested in those tangible assets you find so appealing, the company's actively losing 25 cents. The assets are fundamentally destroying value right now. And furthermore, while sales declined, yes, 11.01% year over year, the true measure of contraction is quarterly. Sales fell by a catastrophic 70.67% quarter over quarter. I mean, that level of contraction severely undermines the viability of whatever stabilized business you believe remains.
Okay, I agree those historical margins are ugly, but they also explain the why of the strategic move, right? The bullish case, for me, rests on the structural integrity we see reflected in the balance sheet. When we examine Outdoor Holding Company, we see classic deep value indicators. The company trades significantly below its tangible asset backing, posting a price-to-book ratio of just 0.76. That's a powerful signal, I think, that the market is discounting the asset value per share, which stands at a solid $1.90.
A discount on depreciating, loss-making assets? Perhaps. Yes.
Well, I would counter that the debt structure provides a huge floor for the value here. The leverage is exceptionally low, with a debt-equity ratio of only 0.11, and long-term debt barely even registers at 0.10. More critically, the liquidity provides the necessary cushion for surviving this exact period of transition. The quick ratio and the current ratio both stand at a remarkably strong 3.28, and this company also holds $0.54 per share in cash. So this means they have the operational runway, essentially guaranteed by cash and low debt, needed to restructure successfully. And we also have to note the forward-looking expectations. Earnings show a huge projected reduction in losses, moving the next year's EPS projection from that trailing 12 months loss of negative $0.52 to just negative 0.06. That suggests the market believes the restructuring has removed the primary source of the bleed.
Okay, let's delve right into that strategic transition then, because that is the most critical point of disagreement, I think. I find it really difficult to reconcile the projected EPS improvement you cite with the reality of the revenue base, the sale of the ammunition manufacturing assets. I mean, that segment previously generated the majority of revenue. So if we've sold off the core revenue engine, why should we trust a forecast that suggests immediate margin relief? That 70.67% quarterly sales drop validates my fear. The company is now just a fraction of its former size. Future profitability has to be based on a radically smaller, yet hopefully highly scalable marketplace business.
The premise of your concern is sound. Revenue contraction is definitely worrying. But I would frame the quarterly sales collapse as the inevitable and frankly necessary cost of the strategic pivot. The significant leap in forward EPS estimates, moving from negative 52 cents to negative 0.06 cents, directly suggest that the assets they disposed of were the primary source of the massive operational losses reflected in the current margins and that negative income figure of over $61 million. This transition, which involved shifting leadership and some major corporate settlements, was an aggressive effort to pivot away from the high fixed costs and, let's face it, inherent volatility of manufacturing.
But this relies on a huge assumption that the Junbroker.com marketplace segment is capable of somehow absorbing that lost revenue base quickly and that it can scale up its contribution to provide a sustainable, high-margin future. We have no definitive evidence yet that the remaining business can manage that shift without the support structure of the manufacturing segment. It feels like a huge gamble on execution.
It is a bet on execution, yes, I agree, but the financial metrics provide comfort during that bet. The move shifts the business toward a theoretically higher margin, asset-light model focused on the transaction platform. We are valuing the new outdoor holding company, which is structurally set up to staunch the bleeding, as indicated by that forward EPS number. The market's expectation, moving from a 52-cent loss to a 6-cent loss, feels like an explicit recognition that the real pain was centered in the discarded assets.
Okay, well that takes us back to valuation then. Your argument heavily relies on that PB ratio. You see the PB ratio of 0.76 as a powerful signal of fundamental undervaluation based on tangible assets. And you couple this with a low enterprise value to sales multiple of 0.98, suggesting a classic value play.
Precisely. A PB below 1 suggests an attractive margin of safety against the tangible balance sheet. It's textbook.
I'm sorry, but I just don't buy that the PB is a compelling floor here. Trading below book value is frankly less important when, as I pointed out earlier, the return on invested capital is negative 25.15%. That discount is justified when the company is actively destroying shareholder value with those very assets. The low sales multiples, PS of 1.28 and EV sales of 0.98, they seem entirely justified, if not generous, considering the stunning 70.67% quarter-over-quarter sales collapse. The critical question isn't undervaluation, it's whether there is a viable, profitable operation left to successfully monetize those assets. If the remaining assets cannot generate positive returns, then that low PB ratio is merely reflecting the reality that book value is eroding and eroding quickly through massive operational losses.
Okay, even conceding the current operational drag, that brings us right back to the balance sheet health, which I still think is the key differentiator here. Few companies undergoing such radical strategic surgery possess this level of stability.
But we need to analyze why such liquidity is necessary. High current and quick ratios merely demonstrate the ability to cover short-term liabilities, which is good, sure, but they do not address the operational drain evidenced by that negative 46.72% profit margin. This substantial cash balance is essentially just a burn rate buffer. It's currently being used to fund massive ongoing losses, not growth or, investment in the marketplace platform. Its sheer size simply reflects the magnitude of the underlying operational problems they are trying to compensate for.
But let's talk about the necessity of financial strength in a crisis like this. A company undergoing a massive, painful restructuring and facing extreme revenue volatility, well, it needs exceptional liquidity and low debt to weather the transition without collapsing or, crucially, requiring dilutive capital raises. The current ratio of 3.28 and the exceptionally low leverage ensure the company has the runway needed to execute its pivot without external capital stress. In essence, by retaining cash and minimizing debt, they have effectively purchased the necessary time to transform the remaining business into a profitable enterprise capable of meeting that improved forward EPS target. Liquidity is the insurance policy against the very execution risk you are so concerned about.
Okay, an insurance policy. But even with that policy, the history of corporate governance raises, for me, serious flags regarding the management team's ability to actually execute a successful turnaround. We can't just divorce the financial performance from the organizational stability, can't we?
I acknowledge the administrative issues that led to those delayed filings, absolutely. However, the company did announce it regained full compliance with the NASDAQ rule in September 2025. Furthermore, external analysts still maintain a recommendation score of 2.00, which, suggests a hold or maybe even a buy bias. And they have an average target price of $1.77, which sits about 18% above the current $1.44. This suggests that external expertise believes the stabilization and pivot efforts are at least credible.
The history of continuous leadership transitions, the public lawsuit settlements we saw, and the multiple NASDAQ deficiency notices received recently, related to filings in November 2024 and February 2025, those raise profound concerns for me about internal control quality and, frankly, execution capacity. These feel like deep structural organizational risks that often accompany a massive long-term stock decline, like the 55% 3-year performance drop we've seen. I view the temporary regaining of compliance as a necessary survival step, sure, but not a definitive sign of fundamental governance health. And the market's price target, which is only 18% above the current depressed price, well, that seems tentative at best, given the inherent risk here.
Ultimately, we've established a clear tension here, haven't we? It's between the structural safety offered by the balance sheet and the pain reflected in the income statement and recent execution. It's a trade-off.
A fundamental trade-off that demands scrutiny, absolutely. Are they restructuring their way back to profitability? Or are they simply burning through cash to delay the inevitable consequence of a collapsing revenue base?
So my final summary is this. Outdoor Holding Company possesses substantial financial safety nets, exceptionally low debt, high liquidity, and assets that are currently trading below book value at PB 0.76. These structural advantages, combined with the positive forward-looking signs of drastically reduced projected losses, suggest the price reflects operational issues that are actively being cleared up post-asset sale. If the market is correct in its projection that the losses have been stemmed, then the current low valuation represents a significant upside opportunity, protected by what looks like a fortress balance sheet.
And I conclude that the structural advantages you highlight are simply overshadowed by dramatic operational failure, evidenced most clearly by the negative 46.72% profit margin and that staggering 70.67% quarterly sales drop. Until there is clear, material evidence that the remaining gunbroker.com marketplace segment can deliver sustained, profitable revenue growth, the company remains, in my view, highly unstable. This instability, coupled with the organizational execution risk we discussed, makes the low valuation seem like a fair reflection of extreme fundamental risk and the high probability of further book value erosion.